Something snapped in the silver market over the last day, and it wasn't subtle. Physical silver printed above $100 in a major Asian pricing hub, while the Western spot price sat noticeably lower. That split should have closed fast. It didn't. And when a gap that obvious refuses to behave, it usually means one thing. The plumbing is clogged, the metal is tight, or the rules are changing behind the scenes. So, here's exactly what happened. The physical benchmark in Asia pushed into triple digits, and at nearly the same time, the Western market traded in the low 90s. Normally, traders jump on that spread. Shipments move, paper adjusts, and the gap compresses. But instead of snapping shut, the gap stayed stubborn. That's the kind of signal you do not ignore, because it suggests the price you're seeing on paper is not the same as the price the real world is paying for real ounces. Now, before we go deeper, I need your help with something, and I'm going to keep it direct. I'm running a campaign to eliminate copycat channels that recycle the same talking points, the same clips, and the same narratives, and then pretend it's original analysis. If you want to support the original work here, subscribe right now and drop a comment that says OG John AG. That one comment helps more than you think because it tells the algorithm where the real community is. And because this campaign is about building a real audience, I also created a WhatsApp channel for the people who actually want daily updates, short notes, quick alerts, key ideas, and the things you'd rather see early than late. The link is in the description. Join it because in a market like this, the move doesn't wait for the weekend. All right, back to silver, because the story gets stranger the closer you look. When physical silver trades above $100 in a major hub, it doesn't just mean silver is up. It means someone is willing to pay up to secure metal now, not next month, not a promise now. And when the Western price lags at the same time, the uncomfortable question is, why isn't metal flowing the way it used to? People love to call every spike hype or speculation, but the fingerprints right now don't look like a typical blow-off. One of the biggest tells is open interest behavior. In many historic runs, a parabolic move is accompanied by open interest rising, meaning more leverage, more speculators, more paper piling on. But when price surges while open interest falls, that often points to shorts closing and risk being reduced, not a frenzy of new paper longs. In other words, the pressure may be coming from real demand and forced exits, not just gamblers pressing buttons. And let me connect this to something that happened on the equity side, because it matters more than most people realize. In the middle of this surge, certain smaller mining stocks faced buying restrictions through major clearing pathways. The message wasn't be careful. The message was effectively you can sell, you can liquidate, but buying is limited if the company is too small or the share price is too low. Read that twice. Selling is allowed. Buying is the issue. In a genuinely free market, that's backwards. And you know it. Now ask the obvious question. Sell to who? Because if the public is being nudged towards selling, somebody else is quietly positioned to collect. That's how squeezes and re-ratings get built. Not with a trumpet. With friction in the places that matter. So the easy money gets first access, and the late money gets the leftovers. Now think about what that means for junior miners specifically. There's a big difference between pure exploration stories and restart candidates. Explorers are hope and drilling. Restart plays are known mines with a clearer path. Permits, funding, equipment, and production. When silver gets hot, restart plays can re-rate violently because the market starts pricing future cash flow, not future guesses. So, if access gets restricted right when silver is screaming higher, you have to ask, is this risk control or is it gatekeeping before the crowd arrives? This is why I keep saying the most important clues aren't always the candles on your chart. They're the behaviors around the market. When spreads stop closing, when inventories draw down, when access gets managed, when the narrative turns into a coordinated warning chorus, those are tells. Those are the moments when the system is trying to control the timing of participation. And timing is where most people lose money. Now, there's been discussion about leasing and borrowing in the silver world. And here's the weird part. you would expect borrowing costs to explode in a genuine physical squeeze. If metal is scarce, the price to borrow should rise, not cool off. So when you see signs of borrowing rates backing away from extreme levels, while physical tightness seems obvious, you have to consider the possibility that the indicators are being smoothed, delayed, or made less informative. I'm not claiming any single number proves anything. I'm saying the pattern fits what stress systems often do. They try to look normal until they can't. And then you zoom out and you notice something else. Governments and major financial players are talking more openly about securing strategic minerals and supply chains. That matters because silver is not just jewelry and coins. Silver is an industrial input, electronics, energy technology, defense applications, medical uses. The point is simple. If the world needs it, the world will bid for it. And when the world bids for it while supply is constrained, paper promises become a problem. Here's the part that makes people uncomfortable. So, I want you to sit with it. The paper market can trade absurd amounts of silver without moving a single bar. That works only as long as physical can be sourced when needed to close gaps and settle obligations. If physical becomes harder to source, the paper price becomes less authoritative. It becomes a suggestion. And when that happens, the market doesn't drift to a new equilibrium. It jumps. And notice the emotional whiplash, too. One day, you're told silver is boring, obsolete, and dead money. The next day, the same crowd screams that it's dangerous, overheated, and ready to crash. That flip isn't analysis, it's crowd control. It's designed to make you sell strength, chase weakness, and always feel late. Don't play that game. If you feel confused, that's the point, and it's working today. Now, I know what some people are thinking. If it's over $100 somewhere, why doesn't everyone just arbitrage it? Great question, because arbitrage isn't a magic wand. Arbitrage needs transport, approvals, inventory, and willing counterparties who actually perform. If the metal can't move freely, or if it's already spoken for, or if new approvals slow the pipeline, the gap can persist. And persistent gaps are not a sign of efficiency. They are a sign of stress. Let's talk inventories for a moment because this is where the story becomes real. When visible stocks in key venues start dropping while price rises, that's not a chart trick. That's metal leaving the shelf. It's demand pulling supply out of the system. And if supply is being pulled faster than it can be replaced, the paper comfort disappears. Because paper can be expanded instantly. Physical cannot. Now I want to address the rumor culture that always explodes during moments like this. You'll hear claims about massive short positions, secret reports, emergency meetings, and someone is about to blow up. Some of that is nonsense. Some of it is half true. Some of it is misdirection. But here's the key point. You don't need any single rumor to be true for the structural risk to exist. If any major participant is structurally short into a tightening physical market, the exit routes are limited. They can deliver metal, buy back at higher prices, or try to settle in cash and hope nobody notices what just happened. In calm markets, those options look manageable. In stressed markets, two of those options become painful, and one becomes reputationally dangerous. And that's why the next phase of this story is not about what silver should do. It's about what the system can tolerate and what it will do to buy time. That is also why physical holders are in a unique position. If the system needs metal to relieve pressure, physical becomes the exit door. So, you need to be clear about what you own and why you own it. If you hold physical as long-term protection, you don't let a headline shake you out. If you hold it as a trade, you manage it like a trade. But don't confuse the two at the worst possible moment, because that confusion is where regret is born. And let's be honest. This is the moment when the market tries to trick you. Price goes vertical. Fear shows up in a new costume, and suddenly the same voices that mocked silver at $25 start telling you it's too high at $90. That's how people get shaken out before the next leg. The trick is always the same. Make you doubt your plan when the plan is finally working. Then buy what you sold. Now I'm going to do something that many channels won't do. I'm going to ask you to participate. If you think the triple-digit physical print is the real price and the Western spot is the lagging illusion, comment physical leads. If you think the Western spot will pull everything back down, comment paper wins. I want to see where this audience stands because the comments reveal sentiment, and sentiment matters in a squeeze. And here's a second question for you. What do you think is keeping that gap open right now? Movement restrictions, genuine scarcity, or deliberate management? Pick one and tell me why. If you're right, you'll have a framework you can reuse the next time markets get weird, because the next time will come. Now, quick detour because some of you asked for motivation and real-world examples. If you want silver-related success stories, there's a link in the description to a channel that focuses on those stories. Go subscribe there too, because hearing how people actually made money can keep your conviction steady when volatility tries to mess with your head, and it reminds you that patience gets paid. Back to the mechanics. There's another bullish but dangerous signal in play. When price rises and the speculative crowd is not fully participating, the move has room. If open interest is down and the surge is being driven by industrial demand and forced short covering, then what happens when momentum traders finally pile in? That's when you can get the kind of acceleration that turns a rally into a regime change. And regime changes are where the big money is made and the big mistakes are made. And if you think that sounds dramatic, look at how systems behave under stress. First, you see small rule changes that get labeled risk controls. Then you see access issues. Then you see selective restrictions. And then when the pressure is too obvious to hide, you see the narrative shift from nothing to see here to extraordinary measures where necessary. Markets don't announce the breaking point in advance. They show you the signs, and the signs are already here right now in the spread. Now let's talk about miners again because I want you to understand the chessboard. Big producers can move, but they're often slower because institutions already own them. Mid-tiers can offer a balance of liquidity and torque. Juniors can be rocket fuel, but they come with access risk, financing risk, and broker risk. In a market where buying restrictions are even a possibility, that access risk becomes part of the trade. It's not enough to pick a good story. You need to be able to act when the market moves, and you need to know what happens if the gate gets half closed at the worst time. This is also why some people choose to reduce leverage even while remaining bullish. In explosive phases, volatility can destroy option positions, even if your long-term direction is correct. The market can swing hard enough to knock you out before it continues in your direction. So if you're using leverage, respect the fact that timing becomes the entire game. The goal is to stay in the game long enough for the thesis to pay. Now I want to shift back to the core of today's story. The stubborn gap between physical pricing in Asia and paper pricing in the West is a flashing signal. If that spread persists, the market is telling you physical is being valued differently than paper. And when physical is valued differently than paper for long enough, paper eventually has to chase physical, not the other way around. That's when the chart starts moving in steps, not in lines. And that leads to the biggest cliffhanger of all. If silver is already trading triple digits in a physical benchmark, what happens when the Western market is forced to recognize that reality? Does Western spot jump to close the gap? Do we see more restrictions to slow participation? Do we see cash settlement language creep into the conversation? Or do we see a rush for physical that overwhelms the paper system and rewrites the rules? Because the next headline isn't going to be polite. It's going to be sudden. And it's going to make people wish they paid attention when the signs were still small, when the gap was still just a gap, and when the excuses still sounded reasonable. So, here's my message to you. Watch the spreads. Watch the inventory draws. Watch the open interest behavior. And watch the rule changes. Those 4 things tell you more than any single chart. And if you're in this for the long haul, build a plan that you can execute without panic, because panic is a tax you pay to people who planned. Also, let me say this again because community matters. If you're successful in any area of life, share a quick success story in the comments, not to brag, to lift others. When people see real examples from real viewers, it strengthens the mindset of the entire community. And if you're not there yet, share what you're working on. The comment section should be a place where winners build other winners, and where beginners get honest encouragement. Now, if you've watched this far, you already know this isn't just another silver rally. Triple-digit physical pricing, a stubborn east-west gap, falling open interest during a surge, and access restrictions in key pockets of the equity market are not normal ingredients.